Running a business becomes much easier when your finances are organized, monitored, and managed correctly. In this video, you'll learn how to clean up your business finances, control burn rate, fix poor management practices, and avoid costly mistakes that can hurt long-term growth. Let's begin by organizing the foundation of your business finances. Just follow 5 easy steps for clean financial system. Step number 1. Understanding why messy finance is a system problem, not a money problem. Most business owners believe messy finance means not earning enough money. In reality, messy business finance is almost never a revenue problem. It is a system problem. You can make good sales and still feel broke if money is not organized. When finance lacks structure, money enters your business but disappears without direction. This creates stress, confusion, and constant second-guessing. One major reason finance becomes messy is that most founders focus on action, not reflection. You spend time selling, delivering, and solving customer problems, but you do not spend enough time reviewing numbers. When you do not regularly look at where money comes from and where it goes, small leaks grow into big problems. These leaks often hide inside subscriptions, tools, unnecessary services, or poorly planned spending. Another issue is reacting instead of planning. When income increases, spending usually increases emotionally. You may hire faster, buy more software, or increase marketing without understanding the long-term impact. When income slows, panic spending or borrowing starts. This emotional cycle creates instability. Clean finance requires intentional decisions, not reactions. Messy finance also comes from mixing roles. When the same person earns money, spends money, and tracks money without clear rules, discipline breaks down. You might delay reviews because numbers feel uncomfortable. Avoiding numbers does not remove the problem, it only hides it. To clean up messy business finance, you must shift your mindset. Money management is not about control for control's sake. It is about visibility. When you can clearly see what is happening financially, stress reduces automatically. You stop guessing. You stop fearing growth. You stop making blind decisions. The goal of finance cleanup is not perfection. It is clarity. Once clarity exists, even problems become manageable. This foundation makes every next step easier and smarter. Step number 2, bringing clarity to cash flow without becoming a finance expert. Once you accept that messy business finance is a system issue, the next step is gaining control over cash flow. Cash flow is the heartbeat of your business. You do not need complex spreadsheets or advanced accounting knowledge to manage it well. What you need is consistency and visibility. Many businesses fail not because they are unprofitable, but because they run out of cash at the wrong time. The first mistake owners make is checking bank balance instead of understanding cash movement. A bank balance shows a moment in time. Cash flow shows a pattern. You need to know how money enters your business, how fast it leaves, and where delays happen. This understanding helps you plan instead of react. Start by separating incoming money into clear categories, such as core sales, one-time income, and irregular income. This prevents overestimating stability. On the outgoing side, list recurring payments clearly. Monthly subscriptions, salaries, tools, rent, and marketing costs must be visible in one place. When expenses are scattered, they feel smaller than they actually are. Seeing them together creates awareness. Awareness naturally improves decision-making. Another powerful step is timing awareness. Many businesses earn today but receive money later. Meanwhile, expenses must be paid immediately. This timing gap creates pressure. You reduce this pressure by shortening payment cycles, setting clear payment terms, and following up consistently. Cash flow improves more from discipline than from growth. Weekly review is more effective than monthly panic. A short weekly check helps you spot issues early. You do not need perfect numbers, you need honest numbers. Even rough tracking done consistently beats detailed tracking done rarely. Clean cash flow management gives you calm. When you know what is coming, what is going, and what is delayed, decisions become easier. You stop guessing. You stop worrying. Cash flow clarity turns finance from a source of stress into a tool for confidence. Step number 3, organizing expenses and building spending discipline that actually works. After cash flow, the next major source of messy business finance is poor expense organization. Most businesses do not fail because expenses are too high. They fail because expenses are invisible. When spending is not clearly tracked and categorized, money slowly leaks without anyone noticing. Over time, this creates frustration and confusion. The first step to organizing expenses is clarity. Every expense must have a clear purpose. Ask yourself a simple question before spending. What problem does this expense solve? If you cannot answer that clearly, the expense is likely unnecessary. This mindset alone reduces waste. Clean finance does not mean cutting everything. It means spending intentionally. Another common issue is treating all expenses as equal. Not all spending has the same impact. Some expenses directly support revenue, while others only add comfort or convenience. When you group expenses into categories such as essential, growth-related, and optional, decisions become easier. During slower periods, you protect essentials and pause optional spending without panic. Subscription overload is a modern problem. Many businesses sign up for tools and forget about them. Small monthly charges feel harmless but become heavy over time. Reviewing subscriptions regularly creates instant savings without hurting performance. This is one of the fastest ways to clean up finance without stress. Spending discipline also requires rules. When there are no rules, emotions guide spending. You buy more when you feel confident and freeze when you feel afraid. Clear limits remove emotion. Simple guidelines such as approval thresholds or monthly caps create stability. Expense organization is not about restriction. It is about control. When you know exactly where money goes, you feel confident saying yes or no. Clean expense management removes guilt from spending and replaces it with clarity. This clarity builds trust in your own decisions and creates a strong foundation for long-term financial health. Step number 4, fixing invoicing, payments, and cash delays that quietly hurt your business. One of the most overlooked causes of messy business finance is delayed money, not missing money. Many businesses earn well but still struggle because cash arrives late. Invoicing and payment discipline directly affect financial stability, yet they are often treated casually. Cleaning up this area creates immediate relief. The first issue is unclear invoicing. When invoices are confusing, delayed, or inconsistent, payments slow down. Clear invoices with defined amounts, due dates, and payment instructions reduce friction. Your goal is to make paying you easy, not optional. Every delay increases financial pressure even if the customer intends to pay. Another silent problem is weak follow-up. Many business owners feel uncomfortable reminding clients about payments. This hesitation costs money. Following up is not rude, it is professional. Setting a simple reminder system removes emotion from the process. When follow-up becomes routine, payments improve naturally. Payment terms also matter. If you allow long payment windows without planning, you create cash gaps. Shorter terms improve stability, especially for growing businesses. When possible, advance payments or partial upfront payments reduce risk and stress. Predictability is more valuable than flexibility. Another issue is scattered payment methods. When payments arrive through multiple channels without tracking, visibility is lost. Centralizing payment records helps you understand which clients pay on time and which do not. This knowledge protects your future decisions. Late payments are not just an inconvenience. They force you to delay your own obligations or use personal money to fill gaps. This breaks financial boundaries and increases anxiety. Fixing invoicing discipline restores balance. Clean payment systems change how your business feels. When money arrives on time, confidence grows. You stop worrying about short-term survival and start thinking long-term. Invoicing clarity and payment discipline are not administrative tasks. They are survival tools. Once fixed, many financial problems disappear without additional effort. Step number 5, using financial reviews to make better decisions and grow without fear. Once cash flow, expenses, and payments are under control, the real power of clean business finance begins to show. This power comes from regular financial review. Many business owners avoid reviews because they believe finance is complex or intimidating. In reality, financial review is simply the habit of looking at numbers before making decisions. It is not about perfection. It is about awareness. Many business owners work hard every single day, yet they still feel stressed about money. Sales are coming in, customers exist, but profits never seem to stay. Bills feel heavy, cash feels tight, and financial decisions feel confusing. This usually has nothing to do with intelligence or effort. It happens because business finance is unmanaged, not understood. In this video, you will learn how to fix poor business finance management. Step number 1, establishing complete financial visibility inside the business. Financial problems grow fastest when business owners cannot clearly see what is happening with their money. Visibility is the foundation of strong business finance management. Every financial detail must exist in one place, so decisions are based on facts, not assumptions. Bank balances, cash on hand, pending invoices, unpaid bills, loans, subscriptions, and recurring expenses must all be documented clearly. Relying on memory or checking numbers occasionally creates blind spots. Personal and business finances must be fully separated to reveal true performance. Mixing them hides losses and creates false confidence. Monthly income should be calculated using money actually received, not expected payments. Planning based on future cash that has not arrived leads to dangerous overspending. Every expense must be listed, including small and irregular costs. These small amounts often become the biggest profit leaks over time. Reviewing the last 3 to 6 months of financial activity helps identify patterns, unnecessary spending, and inefficiencies. Understanding the break-even point is essential because it shows how much the business must earn just to survive. Outstanding receivables must be followed up consistently because delayed payments damage cash flow more than low sales. All this information should be placed in a simple dashboard or spreadsheet that is reviewed regularly. Once financial visibility improves, confusion reduces. Clear numbers remove fear, replace guesswork with control, and create a stable base for fixing deeper financial issues confidently. Step number 2, creating spending discipline without harming growth. Uncontrolled spending is one of the most common causes of poor financial health in businesses. Fixing this issue does not mean cutting everything aggressively. It means creating discipline and intention around where money goes. Every business needs a clear monthly spending structure based on real historical data. Each expense category, such as marketing, tools, operations, payroll, and utilities, must have defined limits. Without limits, expenses naturally expand. Essential and non-essential costs must be separated clearly. Many businesses continue paying for software, services, or subscriptions that no longer add value. These costs quietly reduce profits every month. Taxes should always be treated as a regular expense instead of a future problem. Setting aside money consistently prevents stress later. Emergency buffers are also necessary to handle unexpected costs without disrupting operations. Spending should be tracked weekly to identify problems early. Waiting until the end of the month often hides overspending until damage is done. Planned spending must be compared with actual spending regularly so corrections can be made quickly. Emotional spending is dangerous in business. Clear approval rules prevent impulse decisions driven by excitement or fear. When spending becomes intentional and disciplined, cash flow improves naturally, stress reduces, and profitability becomes predictable without increasing revenue. Step number 3, stabilizing cash flow to reduce daily financial pressure. Many businesses focus heavily on increasing sales while ignoring cash flow stability. This creates pressure instead of progress. Cash flow determines whether a business survives daily operations. Payment speed often matters more than total revenue. Improving invoicing systems, follow-ups, and payment terms can dramatically improve available cash. Advance payments or partial upfront payments reduce risk and smooth operations. Supplier payment terms should be negotiated carefully to align with incoming cash. Paying suppliers faster than customers pay creates unnecessary strain. Inventory should be managed carefully to avoid locking cash into slow-moving stock. Weekly cash flow forecasting is one of the most powerful habits a business can build. It reveals problems before they become emergencies. During tight periods, non-essential expenses should be delayed to protect stability. A minimum cash reserve must exist and be protected seriously. This reserve provides breathing room during slow cycles or unexpected disruptions. Loans should never be used to cover basic operational mistakes. Debt should support planned growth, not daily survival. Products and services that generate faster cash should be prioritized, even if margins are slightly lower. Strong cash flow allows calmer leadership, better decisions, and long-term survival even during uncertain market conditions. Step number 4, bringing structure to financial decisions and business behavior. Poor financial management is often caused by emotional decision-making rather than lack of knowledge. Structure protects businesses from impulsive mistakes. Clear financial goals provide direction and boundaries. Targets related to profit margins, reserves, and expense ratios guide daily decisions. Spending rules prevent unnecessary risk and keep behavior consistent. Borrowing limits protect long-term stability. Debt should always have a clear purpose and repayment plan. Major financial decisions should be supported by numbers, not opinions or excitement. Pricing discipline is critical for financial health. Inconsistent discounting quietly destroys margins and cash flow. Key financial metrics must be reviewed regularly to detect early warning signs. Revenue alone is not enough. Financial responsibility should be clearly assigned, even in small teams. Accountability prevents negligence and confusion. Costs should never grow faster than income over time. Documented financial rules help maintain consistency during both good and difficult periods. When decisions follow structure instead of emotion, businesses operate with confidence. Financial stability improves because choices are intentional rather than reactive. Over time, discipline builds trust, predictability, and sustainable growth across the entire business system. Step number 5, turning business finance into a long-term operating system. Fixing business finance is not a one-time correction. It must become a repeatable system that runs continuously. Simple financial tools or software help reduce human error and improve consistency. Monthly financial reviews should focus on profit, cash flow, and expenses instead of only sales. Dashboards provide faster clarity than scattered files or reports. Early warning signs such as shrinking margins or rising costs must be addressed immediately. Financial understanding should improve across the team so daily decisions support stability. Regular expense audits help remove waste before it compounds. Profits should be reinvested intentionally instead of emotionally. Random reinvestment creates risk rather than growth. Financial systems must evolve as the business grows, but discipline should remain constant. Treating finance as a core operating system instead of an administrative task changes how the business performs. Businesses that survive long-term are not lucky. They are structured, disciplined, and financially aware. When finance becomes systematic, leadership stress reduces and growth becomes sustainable. Strong financial systems allow businesses to adapt, survive downturns, and expand confidently without chaos or constant pressure. Most startups don't fail because the idea is bad. They fail because they run out of cash, and that happens when founders don't understand one number called burn rate. In this video, I'll show you exactly what burn rate really means, how to calculate it correctly with a real example, how it affects your runway, and why investors track it so closely. If you want control over your startup cash, don't skip this. What burn rate really means and why it matters. Burn rate simply means how much cash your startup spends every month. It is not about profit, it is about survival. Many founders confuse revenue, profit, and cash flow, but burn rate is different. You can have revenue and still burn cash. Startups fail not because they are bad ideas, but because they run out of cash. That is why burn rate matters more than profit in early stages. There are two types of burn rate. Gross burn is your total monthly expenses. Net burn is your expenses minus revenue. If you spend $50,000 a month and earn $20,000, your net burn is $30,000. Both numbers matter. Gross burn shows how heavy your cost structure is. Net burn shows how fast your cash is shrinking. Burn rate directly connects to runway. Runway means how many months your startup can survive with current cash. If you have $300,000 and burn $30,000 per month, you have 10 months of runway. This number is more important than valuation because valuation does not pay bills. Founders must track burn monthly, not yearly, because cash problems appear slowly and then suddenly. How to calculate burn rate correctly? Calculating burn rate is simple, but many founders do it wrong. Start by listing all monthly expenses. Fixed costs include salaries, office rent, software subscriptions, insurance, and cloud tools. Variable costs include marketing ads, freelancers, logistics, and commissions. One-time expenses like equipment or legal fees should be separated so they do not distort monthly burn. Founder salary must be included. Ignoring it gives a fake picture. Small expenses matter too. Multiple $10 subscriptions silently increase burn. Marketing spend is one of the fastest ways burn rate grows without notice. Hiring too early also increases burn before revenue can support it. To calculate burn rate correctly, start by tracking how much cash your startup actually spends each month. For example, imagine a startup begins the month with $100,000 in the bank. During the month, it spends $35,000 on salaries, rent, software, and marketing. By the end of the month, the bank balance is $65,000. This means the monthly burn rate is $35,000. If the startup earns $10,000 in revenue during that month, the net burn rate becomes $25,000. This simple method gives founders a realistic view of cash usage. Burn should be reviewed monthly. This discipline helps founders stay realistic and avoid surprises. How burn rate connects to runway, investors, and funding. Burn rate directly determines how long your startup can survive. This is where runway becomes critical. Runway means the number of months your business can continue operating before cash runs out. It is calculated by dividing available cash by monthly net burn. A startup with 12 months of runway is considered stable, while one with less than 6 months becomes risky. Investors pay close attention to burn rate because it shows discipline and planning. They want to know how efficiently you use capital, not just how fast you grow. A startup burning cash without clear progress raises red flags. Healthy burn supports measurable growth such as users, revenue, or product development. Reckless burn increases costs without results. Burn behavior changes by stage. Pre-revenue startups must control gross burn tightly because there is no income to offset expenses. Post-revenue startups focus on reducing net burn by improving margins and efficiency. Bootstrap startups usually maintain lower burn due to limited cash, while venture-backed startups may burn faster but must show momentum. Burn rate also affects fundraising timing. Founders should raise capital when runway is strong, not when cash is almost gone. Startups that understand their burn rate negotiate better and avoid panic-driven decisions that hurt long-term value, controlling and reducing burn without hurting growth. Reducing burn rate does not mean stopping growth. It means spending smarter. Many startups fail because they cut the wrong costs at the wrong time. The goal is to remove waste, not momentum. Start by reviewing all recurring expenses. Cancel tools that are rarely used. Consolidate software where possible. Small monthly subscriptions often add up to thousands of dollars each year without founders noticing. Hiring is another major burn driver. Hiring too early increases fixed costs before revenue can support them. Instead, delay full-time hires and use contractors when flexibility is needed. Marketing spend should always be tracked against results. If ads are not producing customers or measurable traction, they are increasing burn without value. Some expenses should never be cut first. Core team members, product quality, and customer support protect long-term growth. Cutting these areas may reduce burn short-term but damages the business later. To extend runway during tough market conditions, founders should delay non-essential projects, renegotiate vendor contracts, and focus on faster cash collection. Warning signs of an unhealthy burn rate include shrinking runway, rising expenses without growth, and repeated emergency funding needs. Regular monthly burn reviews help founders stay in control and make proactive decisions instead of reacting under pressure. Burn rate as a founder's decision-making tool. Burn rate is not just an accounting number, it is a leadership tool. Founders who understand their burn rate make better decisions because they know their limits. When you clearly track gross burn, net burn, and runway, you stop operating on assumptions and start operating on facts. This awareness changes how you plan hiring, pricing, product launches, and fundraising. Strong burn discipline creates confidence. It helps founders stay calm during slow months and aggressive during growth opportunities. Instead of guessing how long cash will last, you know exactly how many months you have and what actions increase or reduce risk. This clarity improves long-term thinking and prevents panic-driven decisions. Burn rate also improves communication. When founders can explain their burn clearly, investors, partners, and team members trust their leadership more. It shows control, planning, and financial maturity. Startups that fail often had good ideas but poor cash awareness. The most important takeaway is this: cash is oxygen for your startup. Burn rate measures how fast you are using that oxygen. Growth without burn control leads to shutdown. Burn control without growth leads to stagnation. Sustainable startups balance both. Founders who master burn rate protect their company, their team, and their future. Let's explore 10 business finance mistakes that rarely get discussed but can have a major impact on long-term success. Mistake number 1: confusing cash balance with financial health. One of the most ignored business finance mistakes is assuming that a healthy bank balance means a healthy business. Many business owners feel relaxed when they see money sitting in their account. But cash balance is just a snapshot, not the full picture. That money may already be committed to salaries, taxes, refunds, or supplier payments. When you don't separate available cash from future obligations, you start making wrong decisions like expanding too early or increasing personal withdrawals. Businesses fail not because they run out of money suddenly, but because they misjudge how long their money will actually last. Mistake number 2: treating profit as spendable money. Profit on paper feels exciting, but profit is not free money. Many business owners treat profits as rewards instead of responsibilities. They upgrade lifestyles, buy new gadgets, or increase personal spending without realizing that profit must first strengthen the business. Profit is meant to build buffers, handle slow months, absorb mistakes, and fund future growth. When profit is immediately consumed, the business becomes fragile. One unexpected expense can cause panic. The mistake here is emotional spending disguised as financial confidence. Smart businesses delay gratification and let profit work for stability before personal comfort. Mistake number 3. Ignoring the cost of founder time. Most founders never assign a financial value to their own time. They work long hours for free and believe this is saving money. In reality, it hides inefficiency. When your time has no cost, bad decisions feel cheap. Meetings stretch longer, low-value tasks pile up, and systems are never built. If you had to pay someone else for your hours, you would optimize immediately. This mistake creates businesses that depend entirely on the founder. When the founder gets tired, sick, or distracted, revenue suffers. A business without time cost awareness is not scalable. Mistake number 4. Over-optimizing for tax, under-optimizing for cash flow. Many businesses focus more on saving tax than managing cash flow. They make decisions just to reduce tax liability, even if it hurts liquidity. Buying unnecessary assets, delaying invoices, or blocking money in deductions can create cash shortages. Tax savings look good on paper, but cash flow keeps the business alive daily. A business can be tax efficient and still collapse due to cash gaps. Smart finance prioritizes survival first, optimization later. Cash today is often more valuable than tax savings tomorrow, but this balance is rarely discussed openly. Mistake number 5. Not pricing in risk and uncertainty. Most pricing models assume everything will go as planned. No delays, no refunds, no bad clients, no market changes. This is unrealistic. When businesses fail to price in risk, they operate on thin margins that break easily. One late payment or cost increase can wipe out profits. Risk is not negative thinking, it is realistic thinking. Every business should have a stress-tested price that accounts for uncertainty. Ignoring this mistake creates businesses that look profitable in good months, but struggle badly in average or bad months. Mistake number 6. Depending emotionally on one revenue source. Having one strong revenue source feels comforting, but emotional dependence on it is dangerous. Many businesses avoid diversification because this is working right now. The mistake is not about having one source, but about ignoring its vulnerability. Clients leave, platforms change, markets shift. When income is emotionally protected, warning signs are ignored. Businesses delay backup plans until it's too late. Financial maturity means respecting what works today while preparing for the day it doesn't. Stability comes from optionality, not attachment. Mistake number 7. Mixing personal financial anxiety with business decisions. Personal money stress silently affects business finance decisions. When founders are anxious about personal expenses, they underinvest in marketing, delay hiring, or avoid necessary tools. These decisions feel safe but actually slow growth. The business ends up funding personal insecurity instead of strategic expansion. This mistake is rarely discussed because it feels personal. Strong businesses require emotional separation between personal survival and business strategy. When business finance decisions are driven by fear instead of numbers, long-term damage follows quietly. Mistake number 8. Measuring success only monthly, not over time. Many business owners judge performance month to month. One good month creates overconfidence, one bad month creates panic. This short-term thinking causes reactive decisions like sudden cost cuts or impulsive spending. Real financial health is measured over trends, not isolated results. Businesses are seasonal, cyclical, and affected by timing. When decisions are based on short snapshots, strategy becomes unstable. Long-term tracking builds calm decision-making. The mistake here is emotional volatility disguised as financial responsiveness. Mistake number 9. Not budgeting for mistakes and learning costs. Every business makes mistakes, but few budget for them. Refunds, wrong hires, failed ads, legal corrections, and learning experiments cost money. When these expenses are unplanned, they feel like disasters. Businesses that budget for learning stay calm and adaptive. Businesses that don't panic and freeze. Mistakes are not optional, they are part of growth. Ignoring this truth makes every error feel fatal. Smart finance accepts imperfection and plans for it instead of pretending everything will go perfectly. Mistake number 10, believing finance is secondary to growth. Many founders believe finance can be fixed later, once growth is achieved. This is one of the most dangerous beliefs. Poor financial habits scale faster than good ones. Growth amplifies mistakes. Weak financial discipline during early stages becomes uncontrollable at scale. Finance is not the support system of growth, it is the foundation. Businesses that respect finance early gain flexibility, confidence, and control later. Those that ignore it end up chasing revenue just to survive. Growth without financial clarity is not progress, it's pressure. If you found value here, like the video, share it with someone who needs it, and subscribe for more.